today's episode, we talk about the different aspects of an agency's employee compensation. We break down how to design salaries, bonuses, and long-term incentives in a clear, intentional way.
All right, Sei-Wook. So we know comp is a very important factor when it comes to employee recruitment as well as retention. But of course, it's also not the only factor. So, I think before we dive into it, we should make it clear that, look, when it comes to having an agency that, has a good amount of talent density and is able to keep these really talented folks, other factors matter quite a bit. And some of those things are culture, manager strength. So basically, like, how good is the manager? Also, like, the type of work. Is it challenging, exciting work? And then, the other side is, what's the trajectory of the company? Because people want to be in a winning situation. They don't want to be on a sinking ship. So it helps if you have a rocket ship and everyone wants to be along for the ride. So we say all these things because comp isn't the end all be all. Like, you're not going to solve a lot of retention, or you're not going to attract really great people just because of comp. But at the same time, comp is super important because it is dollars that you're really committing, investing in employees. And we like to think that the more intentional you are, the less issues you're going to have in the long run, and you're going to be just smarter about how you handle this. So we got the various kind of components or aspects that we're going to cover today. And so we'll just dive in, and let's start with the first one. You want to take it off?
Yeah. The first aspect of comp might be self-explanatory, is base salary. So thinking about what is the consistent amount that people are expected to be paid on a regular basis, typically every 2 weeks or biweekly. So yeah, the base salary, I would say, is kind of the most important thing to nail right off the bat.
Within base salary, obviously, there's a lot of things to consider. So, first of all, as an agency, you really have to think about your ability to pay a competitive salary rate. And I think a lot of times some people kind of go off of, let's say there's reports out there on, like, hey, what is a acceptable salary range for certain types of roles? So, let's say a project manager should make X to X dollars, in these kinds of markets, or a designer should make XYZ, or a developer should make XYZ. And then there's other aspects to that, especially like where you're hiring these people, right? The geography of where these folks are and how that impacts the salary that you decide to pay. So yeah, anything else on that front of, like, first, like, yeah, you got to know, because sometimes, you're going to be priced out of certain types of talent just because you just don't have the resources.
Yeah. So a lot of this comes down to, what is your kind of business model? How are you pricing your work, and what margin do you have? And kind of working backwards to say, what are the salaries that you as a business can afford? And then from there, how can you represent that in different ways? Like, maybe for certain roles or certain levels, you can afford to pay more, and, factoring in things like utilization and how much you expect someone to be billable. And then that's where you can play, I think, in a kind of remote environment. Can you find team members in different areas for certain roles to help kind of balance out the different salaries that you're paying across the company?
This is why I think it's almost futile, or like, it's not the most helpful to ask other agency owners, like, hey, what do you pay for these roles? I mean, it might be good as a kind of range or signal on, like, what the market is paying, but we've seen this over the years where you can get really talented folks in different areas, whether it's, kind of different parts of the US or internationally. You can get, like, really amazing talent for maybe a salary range that's akin to what, like, an entry-level person might make in, on the coast of the US. On the flip side, like, we might be paying a really hefty sum for somebody based in New York City, but their experience level or the quality might be lacking. So, it just kind of really goes to show that there's no consistent / figured out levels of base salary, but there's a bit of price discovery that you got to do.
I think once you kind of go through that exercise and determine what you can afford as a business, one exercise that we do is kind of generally set salary bands. And this kind of aspect has varied a bit as, geography has obviously impacted this, but just understanding what can your business afford for that given role, and kind of mapping that out loosely, and not as something that needs to be published to the team and shared, but more from a kind of business owner standpoint. What do you expect all the way through?
Yeah, the salary band, you got to grow into it, because you can't just start with like a empty salary bands and kind of try to fill it that way. You almost kind of, and this is the more organic way that we've experienced it, is, once you kind of hire a cluster of folks and, so you have more than, let's say, 2-3 employees, but maybe you get to 10, 15, 20, 30 employees, and, you start to have different levels as well. Like, you think about, okay, there's junior level, mid-level, the senior, maybe there's a director level, maybe a VP level, whatever it might be. And then so within that, depending on the department, you start to kind of go, okay, like juniors are in this kind of salary band, maybe directors are in this kind of salary band. And that gives you just some ranges for you to understand. And then that also ties into the career growth promotion path, right? So if you want to talk on that.
I think along with that is really having a outlined method for looking at compensation reviews. So on a regular basis, having a way that people know that, if it's once a year, we're going to have a conversation about comp. It's based on certain criteria. And from the company's perspective, having a kind of a structured way to look at typically, from a annual perspective, we might do a 0 to 5% raise. But if people, want or desire more than that range, having a path saying, all right, you know what, in order to jump 10, 20% from where you are now, maybe there's a path, a career path and certain roles that you need to grow into over time to get there.
Basically, with this kind of career growth promotion path discussion, it's also figuring out, hey, does this person, this employee want to be kind of on this individual contributor path of like continue to be, more skilled and better experienced at the work? Or, is there kind of like a manager path that they can be put in charge of other people and kind of growing their own team and direct reports? So, those are different kind of conversation, and that has impact on what base salary ultimately becomes. Okay, so yeah, that's a lot on the base salary. Shall we move on to the next one?
Yeah. So the next aspect is benefits. So benefits, I would say, especially in the US, health insurance is a really big bucket where it can cost a company a significant amount of money, but also people weigh it significantly because it's an important part of their costs that they may need to incur. So just thinking through how you're contributing to a health insurance plan. In some instances, we've seen companies just contribute a fixed amount so that employees can go out and get their own plans. In other instances, companies sponsor their own plans and can cover a percentage amount, a fixed amount. But all of this, is an important layer, especially when people are comparing different offers that they have from other companies.
Just like with the base salaries, if you're a smaller agency and you're trying to get things going financially with the business, you have to be pretty conservative here. Right? We all want to provide great benefits to employees. I mean, I think that's just something we all inherently want to do, but you also have to kind of weigh that against like, look, health insurance, there's been a trend of rising costs year over year. And, the more you promise, let's say, to cover 100% or a big significant chunk of someone's health insurance, and, sometimes you might even offer to cover for their families, their significant others, children, whatnot. Like those things can really add up, and it could put the business in a tough spot, especially if you can't support that financially. And so, like, I think there's a lot to be weighed there. And part of it is you can end up, creating a situation where people, can self-select because of that. Because, a lot of times if health insurance is such a huge aspect, let's say, I think that will, automatically filter out those who will select another company, if they have an offer from who has much more robust health insurance plans. Or sometimes, you might be in a situation where employees, spouse, for example, works at a much larger corporation and they're able to put the whole family on that plan. And, that's worked out, well for us in certain situations where, okay, cool. Like we actually don't have to do healthcare costs for that individual. So yeah, I think it's just kind of something to think about, because this is a huge cost. That's why, it's something that we think a lot about, especially during our M&A process as well. Like, hey, what is the health insurance setup? And, you want to be comparable with the plans, but you also want to set it up so that you're not, on the hook for a huge expense.
Yeah, I think it's definitely looking at the all-in costs of, it's not just the salary, but, the benefits can be a big factor there. And then another one is retirement contributions. So like 401k contributions matching from a company's perspective beyond just offering the benefit itself. I think that could potentially add up a lot if you've committed to contributing a significant portion of an employee's salary.
Yeah, exactly. And a lot of this, you have to think about the presentation of it, because a lot of these convos, base salary and benefits especially, come at the offer stage, and you have to think about the comp package, holistically, because there's salary and benefits combined is the comp package. But sometimes you can have a higher salary leaner benefits, or you could have a lower salary, higher benefits, and you just kind of have to think about what's more attractive for the type of people you're trying to hire, and also what makes sense for the business in the long run.
Cool. And then one other thing that I'll kind of put in this bucket are like ancillary benefits. So typically a company might do some kind of milestone based gift. So like for someone's birthday, you might have a additional PTO day, or they hit a anniversary milestone. There might be like an additional gift or PTO or some other form of compensation that ultimately does cost the company something, whether it is dollars or PTO, for example, which does ultimately have a cost. But all of these things factor in when kind of thinking about benefits. And I guess to that matter, just, PTO plans that you're offering to different team members. Do you have a fixed plan across the board? Do you have unlimited PTO? There's all of these are factors when people decide to accept your offer or not.
The milestone gifts, you could be pretty creative there. I know for Barrel, and we call it a Barrelversary, right? Whenever it was the anniversary of them being hired, one of the things we do is, give a Airbnb gift card. It's basically $100 times the number of years they've been. So, you get on to 4, 5, 6 years, you're getting a good gift card that you can take your vacation next time with. So moving on, the next bucket is bonuses. And we kind of talk about these in two different flavors. So let's dive into the first one.
Yeah. So the first one is, or you may see commonly as an annual bonus or some kind of periodic bonus where it can be tied to, some kind of performance metric. So let's say that the company reaches some kind of milestone, or a group or department hits some kind of KPI that you could, measure. And then, at that moment, you could decide to give a bonus to the whole team, to a specific individual or a group. And that's just another way to kind of incentivize behavior that's tied to performance of the company or the group.
Yeah. I mean, one way to think about it, I always, going back to kind of the time I worked in investment banking, right? Like the annual bonus was actually a huge part of that culture. It was like, okay, you work your butt off for the whole year, and then, kind of come end of the year or start of the new year, like, you're waiting for that bonus to hit. In that way, it's like, it's a predictable, like, part of comp, as in like, okay, like I have my base salary and I have my benefits, but like the bonus is a huge part of it. And I think the annual bonus, or whatever, the periodic bonus, is that kind of a mechanism where it's like, all right, like the bonus is, definitely a part of my comp.
Yeah, in some industries, it could be more than your base salary, right? As a annual bonus, and people start ending up expecting it as part of their overall comp package, where they're looking at the bonus as a significant part. If you get it or you don't get it, the variability there can have a major impact on how people perceive their comp for that year. The other aspect is more of a I'll call it ad hoc spot bonus. So this is a discretionary amount that you're giving to a person or individual. So let's say there's, truly exceptional performance that you can point to where a team really over-delivered for a client on a specific project. Client was happy, the company made a lot of money, and you could use a spot bonus as more of a tool to acknowledge that, like this behavior, what you guys said, like we really appreciate it, and then we want to acknowledge you for it.
I mean, spot bonuses are pretty effective in the sense that, it doesn't cause the entitlement factor that, kind of the periodic bonuses can do. And also like the recipient is truly delightful for them, because it's kind of like, oh, cool. Like, I've been recognized for this. I think when you and I talked about like, what are the potential risks for this? I think that there's an aspect that it could feel arbitrary. I mean, especially if the recipient might tell others, oh, I got a spot bonus or whatever. It might be, kind of word gets out that there are spot bonuses, and those that everyone believes they work very hard, and it's kind of like, hey, like, where's my spot bonus? And so I think there's a degree of that risk of, okay, like at least with a periodic, like let's say an annual bonus, like everybody is going to get something. And, I mean, the amounts might vary, but there's a structure there. With spot bonuses, I think the discretionary nature can be its own risk.
Yeah. Although we've also seen it where, with Barrel, like they do like an employee of the month election where everybody at the company votes to select an individual that really went above and beyond in the past month. And, it's a group selection. So it's not it feels like, one person coming down and say, hey, you deserve it. That has, variable ways of compensation, like gift cards or extra PTO days, or, you could find ways to be creative about how to acknowledge that behavior. But that, that's kind of like a spot bonus that's, a group selected.
It's a little bit hybrid because it's happening every month. And so there is a bit of a periodic structure to it. But then at the same time, it is spot in the sense it's not everyone.
Thanks for listening to Agency Habits Podcast. A quick heads up, Barrel Holdings is acquiring agencies. We look for profitable firms with durable revenue and strong teams. If you're thinking about succession, de-risking, or scaling with a partner, visit barrel-holdings.com to see our buy box and set up a confidential call. Thanks.
Okay, so moving on to the next one, we're going to talk about variable comp / commissions. And, this type of comp is, we like to think of it as more specific to certain types of roles. And, specifically in an agency setting, we like to, tie these to kind of sales roles, business development type roles where it's much easier to tie performance, an individual's performance to pure dollar amounts. So for example, like what are the new business bookings for the year, for the quarter, whatever it might be. And so, obviously, we can spend the whole entire episode on this because, it's very, you can get very, very sophisticated on the commission structure, like how you're incentivizing different types of behavior within the sales and business development efforts. But, this is really about how do you design a variable comp structure that is motivating the folks to the behaviors that you want. And we should tie it into kind of what are those kind of behaviors that we're looking for? And also how should these things be covered?
And this is a tricky aspect where, to your point, like you really want to make sure you're incentivizing the right behaviors. So, if you incentivize, a salesperson for selling a project, they may just go just sell volume of projects without regard for the right type of project. Is it, the client going to stick around? And if you're, incentivizing that initial sign, then you may end up with a lot of not high quality projects through the door. Beyond that, just thinking about for these types of roles, having an adequate base salary and then have the variable component be pretty significant that's tied to their performance. And what we've seen for these roles is, you set a baseline quota saying, all right, this is what we expect you to do. And this is, from a company's perspective, they need to hit the baseline in order to cover their base salary costs. But then you can show the potential. So oftentimes you kind of show a OTE, on target earnings, to show, how much can you get if you hit certain milestones. You can earn X amount, and this is where, we want you to be. And then, so you kind of have the both ends of the spectrum, where the minimum and then an ideal outcome. So these team members really get compensated for that performance.
Like we mentioned before, like you can get very sophisticated with how you structure these. And so it doesn't, at a base level, it could be like a certain percentage amount on kind of engagements that you're signing, but then there could be a duration to that. Is it just for the initial engagement, or is it for the next year, or is it for in perpetuity? There's other components too. Like if those clients leave earlier, like is there some kind of a clawback kind of clause to the commissions as well? So anyway, like I said, another episode, we could probably focus on that. So, mainly on the sales side, but the variable comp commissions could also be extended to another role potentially within an agency, right?
Yeah. And where we've seen it is account management or sometimes project management, where team members have the ability to expand accounts. But I think that's, the tricky thing we've seen is as part of an account manager or project manager's role in their job, it is to kind of service and retain a client. So when you think about compensating for, upselling or expansion of accounts, you really need to think about, was that an intentional effort or a really meaningful amount, their ability to expand the account? Or was it just part of the natural course of them servicing the account and organically the client and account grows? Yeah. So that's like the nuance there. The other aspect, you could use spot bonuses as a way to say, hey, I recognize that there's exceptional performance. You really sold this new service line that we're offering, and it's not part of like a strict comp structure where you're calculating exactly what's included and what's not included, but you're still compensating the behavior that you're seeing.
That's a great point. And I think a lot of that is just being creative, knowing that, there's other ways to reward people, outside of a strict commission structure. And maybe one call out, I think, is on the cash flow front with variable comp, just making sure the payouts are tied to, when clients actually pay. And also how do you kind of think about when these payouts happen as well. So, so there is two sides to it. So number one, like just because someone booked a engagement, you don't want to pay commissions on day one because that money's not there yet, and so tying it to when the clients pay. But also when do you pay that? So clients pay, and you want to have is it right away after the clients pay? That's one way. But another way might be okay, we'll hold on to that, but then every quarter we might pay out the owed amounts for all your commissions. You want to kind of avoid, if possible, like kind of backloading commission payouts to the end of the year so that they don't get paid at all until the whole year has passed. So just some things to weigh with variable comp.
Yeah, you want to kind of feel them. People should feel the momentum and like the outcome of their results. They'll get compensated on a regular basis, and otherwise, you could have like a huge cash flow burden at the end of the year to pay everyone else.
Yeah, that's true. Yeah, exactly. All right. So this last bucket, probably, these are pretty big ones, but we're labeling them upside compensation. It's because it's not just a long-term thing, but there's aspects that are pretty immediate as well. And so, yeah, we're going to talk specifically about profit sharing and equity in the agency. So, yeah, let's first dive into the profit share component.
For profit share, kind of broadly, it's setting aside a certain percentage of the profits from the agency and distributing it to the team members. One way we've done it in the past was we set aside a certain percentage of the gross profits from an agency, and then based on everyone's level and tenure at the agency. So we had a formula that decided, all right, the longer you've been here, you get a certain multiplier. At your level at the agency, there's a certain factor. And then you can say, all right, here's the pool, the profit share pool, and everyone gets a proportionate share based on that equation.
Yeah. So that's like if you want to make profit share open to all team members. So that's one possible way. Another one, and we've done this with some of our agencies as well, is like making profit share only eligible for certain levels of leadership. And so this might just be the C-suite, just the CEO, whoever it might be, but like really just tying it with the most kind of direct levers to impacting some of this stuff and making it a significant part of their overall compensation. So that's another one as well.
Yeah, and I think the goal here is really you're trying to share in the overall success with the team. But the other side of it is it requires you to be more financially transparent, because if the profit share is based on the profit, they need to understand like what is the profit of the company, what are the overall financials. We went through this exercise for years of kind of sharing on a quarterly basis. How are we trending? What's the revenue, gross profit, EBIT, et cetera. And you find that for some team members, like it's a lot of numbers. So you're just throwing a lot of numbers at them, and not everyone has the same level of financial literacy to understand like, is this a good thing? Is this not a good thing? Should I be worried about my job? Kind of a downside is if you open it up too broadly without full context and understanding what it is that you're sharing, it could cause questions, concern, where sometimes, it's not really needed.
Yeah. And, just like with any of the other compensation components that we've talked about, like there is administrative overhead to rolling out something like this. And I would say profit share is a significant administrative overhead because, there's the calculations, number one, administrating the plan and, the allocating of the shares to each of the employees or whoever's involved. But then on top of that, setting aside the dollar amounts, and then, just also having rules, like what happens if one quarter you have a lot of profit, but the next quarter you have negative profit, like you lost money. Okay. Do you then subtract some of that negative proportionally out of the profit share pool, or is that protected? So there's a lot to think about there that, you think it's easy and you go, oh yeah, like we put aside X dollars and that's how you're just going to share it. It's not that simple. And then the simple aspect of okay, what happens when you pay out, when do you pay out the profit shares and who's eligible at that point? Because sometimes some people, they might quit and they might be gone before the profit share payouts happen. So what, do they get a proportional amount is it owed to them? Or do you have some kind of rule written that they only get paid if they're still employed on that date? So there's a lot of little details that I think we learned just from administrating these things. And I think it's something for any agency owner to really think through is look, it sounds great. It could be cool to roll out, whatever, but there is an overhead element that you really have to be prepared for.
Yeah. So the next one is equity. So thinking about real long-term upside compensation for people. And this can take the form of various forms of ownership. So like RSUs, options, there's phantom equity. There are many ways that people can accomplish giving equity or the equivalent of equity to team members. And, this could be something that could be vested over time, meaning over 4 years, you'll invest into earning all the equity. Or if the company hits certain milestones, then it unlocks the equity that you have in the company. So that's just really a way for certain team members to have the ability to participate in a kind of future valuation of the agency.
Yeah. So, basically, I think a lot of, in theory, a lot of agency owners think, okay, I'm going to give equity so some of our employees or our employees will feel like they have skin in the game, right? It's like, okay, ownership mentality, they're going to think like owners all of a sudden because they have equity, right? And so, I think that's an easy thought to have when it comes to equity, but I think there are definitely caveats to that because first of all, like equity, I mean, we own, just in our stock portfolios, yeah, sure, we own equity in, Meta or Google or whatever. But like, do we have ownership mentality of those things? Not necessarily. It's a very kind of insignificant amount in terms of like an ownership percentage. But, what do we care about is the value of the stock. And so I think it's important to kind of think through, hey, like, is that being communicated? And what are the levers for kind of unlocking value in the equity? And we can kind of, there's really the one that's most common, which is like, is there a liquidity path for the agency? So is the agency kind of exit at some point and realize some kind of value on this equity?
I think that's probably the most common. Another method is, something called the buyback event, where periodically, let's say it's every year, every 5 years, allow people who have equity to sell their shares back to the company. So you're essentially giving them the value of the business at that moment, and the company then buys it back. But then there is at that moment of liquidity that you're kind of creating. And at that time, you can either fund that just through the cash that you have on your company's balance sheet, or you can bring on new investors to take on that equity and they can buy it from the current equity holders. So there's, just giving the optionality for those people at that time.
I honestly have not heard of an agency do the buybacks. You know what I mean? Like that has not been common, but like, they can actually. So like, this is something interesting. And just think about like, how do, we talked about, okay, employees could be given equity through, like RSUs options or like phantom equity. But I think instead of just kind of awarding these kinds of equity compensation, just also having maybe a path for employees to buy into the company as well. This is, let's say as an agency owner, you're like, okay, I own 100% of the agency, but maybe I'll sell 20% of it to folks that want to buy in. And if there's a good story around it, like, hey, we're working towards an exit in the next 3 to 5 years. I do want to take some, de-risk it a little bit, but give you guys upside if you want to buy into it. It's not that different than selling or bringing on an investor, but you're just kind of offering that up to your own employees.
Another option is what's called an ESOP plan. It's an employee stock option plan where you can set aside a portion or entire business where your employees can own a piece of that company. And essentially a lot of mechanics here where trust is owning the company and the company is paying or buying that aspect of the ownership from the owner. But that's a long-term path where owners can transfer their business to the employees that are in the business.
And this kind of has that buyback element where like as employees kind of leave the company, they're able to, their stocks get bought back by the ESOP. And so that gives them some degree of realizing value on their equity stake. Yeah. So, we should talk, so this is like the long-term, we talk about this as long-term compensation and really like, when and why, should people do this? Because I think when should you not do it? Maybe we should start there because I think we've, kind of used this incorrectly at times. And so I think equity, we take cues from the VC-backed startup world a lot of times and, kind of get misguided there. It's not the same, especially for agencies that, are most likely just on a different path and different capital needs. And so, when should you avoid using equity?
I would say, where it's commonly used is like as a retention tool, saying, all right, we're going to give you equity, but like we said, without any real value or clear path to any kind of liquidity event, like it's just, it's in some ways it could be symbolic, but it doesn't necessarily translate to the result that you're looking for.
And, maybe it buys you time. And so we've been through this and we just heard so many examples of this from other agency owners over the years too. It's just you have a key employee, you're relying a lot on that person and you have fear that they might leave at some point. And so you think that, equity's what's going to kind of keep them locked down basically, right? Like you're going to lock them down with equity, I guess, it's your version of golden handcuffs, but at the end of the day, is it clear what the value of that is? Where is the agency's evaluation now? And what is it that it could be? Those things have to be thought through for it to make real sense. And, I think if that is the main reason to do it, it's probably the wrong way. And so, I think the real, and the way we think about it is the right way is to really align people with the forward-looking kind of perspective on how do we get to a successful exit, in this defined time frame, and how do we all row together? And if we do, then you guys are properly set up to reap the rewards of that effort. So I think that's kind of how we think about it across our agencies.
Yeah, definitely. And I think, along those lines, it's along the way, you may decide that with the equity, there might be some distribution rights that you're giving people so that it's not all lump sum. In 5-7 years down the line, you'll see some meaningful value from this equity, but along the way, there's means something, right? But you need that shared vision on what exactly this is going to be. Why are you doing it in the first place?
Yep.
Yeah.
Okay, cool. So I think that about covers all the different aspects. And like we mentioned, there's so many of these topics that we could go much more deeper into. But, let's just wrap up with a few takeaways in terms of how we should think about just employee comp at an agency overall.
Yeah, I would say, number one, keep things simple at the start. Like many things, benefits, it's one of those things that once you implement a benefit or give someone a benefit, it's really hard to take things away. Like once you have someone get used to annual bonuses, suddenly you say, hey, we're not doing annual bonuses anymore. Or, hey, we're giving you health insurance. And then the next year, no, we're not doing health insurance anymore. It's really hard to pull things away. So I think keep things simple and be realistic on what you can afford as a business.
Yeah, I think just, being conservative there. We talk about staying lean in that regard. And then we talked about, we kicked this off with base salary because at the end of the day, that is probably the most significant, important for all the employees. Obviously, when you get to more executive comp, I think the bonuses and the variability and the long-term, the equity stuff start to matter more. But for the vast majority of your employees, the base salary, having a very clear comp review system of raises and just even thinking about salary bands and other things, I think that's where most agencies can benefit. That's like the 80-20 rule. That's probably where you're going to get the most, figure out most of the things on the comp side. And then, lastly, just the fancy stuff, profit share, equity, all that stuff sounds great, but there's an administrative overhead. So just be very mindful of what you're getting into. All right. Well, thank you for joining us on this episode. Yeah, look forward to catching you next time.